Markets are pushing toward new highs, but the real question is not whether prices can rise. The real question is whether the underlying structure can support it. When probabilities shift, it is rarely because of headlines. It is because liquidity, positioning, and internal rotation begin to align. Right now, we are seeing odds of new highs increase, but we are not seeing a full regime reset. Under our strategy framework, this still maps to late phase 2 pressure, rather than a clean return to early melt-up conditions. Liquidity is not accelerating, it is stabilizing. Credit spreads are not breaking down, but they are not compressing aggressively either. Breadth is improving in pockets, yet leadership remains relatively narrow. Mechanically, this creates a situation where markets can grind higher toward resistance, even as underlying fragility quietly persists. That is how late-cycle probability expansion works. It does not require euphoria. It requires just enough liquidity stability and just enough positioning under exposure to allow prices to test prior highs. In our base case, we assign roughly 60% probability that markets attempt new highs into mid-2026. We assign about 25% probability that liquidity reacceleration extends that move further than consensus expects. And we maintain roughly 15% probability that credit deterioration pulls forward a Phase 3 breakdown before year-end 2025. What confirms continuation is straightforward. Long-term yields need to stall or drift lower. Credit spreads must remain contained. Breadth cannot collapse back into extreme concentration. If those conditions hold, the path of least resistance can remain upward, even within compression dynamics. If you find this type of probability-based regime mapping helpful, consider subscribing. Not because it supports us, but because it gives you a structured lens to interpret markets when narratives get loud and signals get subtle. Now, equally important, this is educational analysis and not financial advice. Markets involve uncertainty and risk, and every framework has invalidation levels. Speaking of invalidation, what would change this view is a disorderly funding shock, a sharp spike in long-term yields, or rapid widening in high-yield spreads. Those signals would tell us that the probability of Phase 3 is rising faster than expected. Until then, the structure suggests cautious optimism, not euphoria. Sequencing still matters, optionality still matters, and probabilities, not headlines, continue to define the regime.